How can compliance teams keep up with technological advances?
Keep the regulators up to date, and innovation and competitiveness.
The UK regulators feel that pressure that we have to up our game.
Definitely.
If you want a zero risk economy, you can have a zero growth economy.
You're kind of implying that it's possible to de-risk too much.
More regulation, less growth is too simple.
It's that whole regulatory problem. Tell us that's gone wrong and then tell us when you fixed it.
Stephen, 15 years of regulatory reform. Do you think we are safer?
Aha. I think that's a great question, Dean. You probably know my opinion on this, and that is that regulatory change, which seems ever present and has for years, pretty much always deals with closing the stable door on the last horse that bolted. And I think that's true of all the regulation that we all worked on after the 2008 crisis. There were some horses that had bolted in that crisis, and things like the Bank Recovery and Resolution Directive and the capital directives and all of that change really made banks much stronger in terms of the things that had gone wrong in the crisis. So the quality and amount of their available capital, the quality and supply of their liquidity, and the ability to close a bank without collapsing a market. All of those things were things that needed dealing with, and the regulation after the crisis dealt with them. Whether we're actually safer depends on what you think happens with risk over time, and I think a couple of things occur to me. One is that quite often in solving one problem, you just kind of displace risk. So, one of the other areas of focus after 2008 was everybody said, we've got to try and get all of these derivative contracts onto platforms, and they've either got to be collateralized, or if you can't collateralize them between parties, they need to be going through clearing houses. And that's kind of fine, but what it did was it moved the risk to places like clearing houses without anybody actually saying, are clearing houses strong enough to be able to take that risk? So often you do risk displacement and you end up with another solution. And the other thing that occurs to me is that because the commercial landscape and the risk with it is changing all the time, regulation is never done, and it doesn't stand still. It needs to move with commerce. Who at the time of the financial crisis had heard of cryptocurrency and artificial intelligence? I certainly hadn't. And now those are the things that we talk about and that regulators are trying to catch.
Do you share that view?
I do. I might add one point to Stephen's points, which is that regulators are, one thing they have learned and the industry has learned is that you can't really predict the future in a sense. And what needs to be always thought about is not the impossible, but the highly improbable. And the regulators really encourage banks to stress test different scenarios, and in the aftermath of the financial crisis, that stress testing was always around capital and liquidity positions. It might have been a trade that had gone wrong or something like that, whereas now they're pushing for banks to stress test more esoteric things that maybe aren't front and center. Could a fraud event, for example, bring down an institution? Could COVID have, or a pandemic? Could the geopolitical environment do it? So really trying to push firms to think broader around some of the issues which might cause it to fail. But I do think the sector as a whole is safer, and as Stephen said, the push on both capital liquidity and on resolution and now on op resiliency all contribute to that.
Does thinking about that broadness come at the expense of business growth?
Well, businesses are always focused on the commercials and making sure that the profits are there. So to agree, I think the banks would have said absolutely at the time of the reform agenda being put into place, in part because they were so underinvested in their risk and control systems. As those risk and control systems have improved and as technology solutions are becoming more embedded, it's probably harder to argue that that's the case anymore, particularly when you see some of the results that are coming out of the banks quarter on quarter.
This point about whether the perception of the balance between regulation and risk is shifting is, I think, a really interesting one. I mean, I think certainly in the US, certainly in the UK, probably even in the EU, the dialogue now is all about, well, our economies are stagnating and we need to, take off the shackles and allow the economies to grow. I mean, a couple of observations on that. One is that there's a more or less endless debate, through the political process, always of where is the right balancing point for that position, and the perception moves over time. Almost nobody wants to live in a society without regulation because you have to protect the vulnerable from the unscrupulous. But where do you put the balancing point? And the political reality is that balancing point moves over time, and we're in a particular place now where the balancing point's being moved. But I think the other thing I would say is that we've learnt over time that just a kind of black and white, more regulation, less growth, is too simple a model, and it doesn't really operate as simply as that. Sure, there's a cost and an inconvenience to, more regulation and more control, but they don't necessarily have to be in opposition, and that you can think about smart ways of cutting out the negative externalities of economic development, and allow the growth to come through. And I think technology is one of the ways in which we can do smarter things with the risks without impinging upon the possibility for growth.
You're kind of implying that it's possible to de-risk too much.
Yeah, I mean, I think you can, if you want a zero risk economy, you can have a zero growth economy.
Right, okay.
And those are available.
Yeah.
If you are prepared to have a little bit of risk in your economy, you'll have some growth and development. But I also think the simple view is to say that more commercial risk necessarily means more regulatory risk. And that doesn't have to be the case. You can allow commercial growth to take place, but with smart solutions you can do that in a way which still contains your risk to consumers or your risk to market stability. I think technology can play a role in that.
And actually, regulators are quite focused on that point in a sense, because if the banks don't exist, and banks are so important to the economy for lots of different reasons, so they often challenge on business model viability. So they are thinking about the fact that banking institutions need to have viable businesses. This was a question that came up a lot post-Brexit when business was being transferred across to the EU. And they're also very focused on innovation. You see that through some of the things they want firms to focus on, the sandbox idea with FCA. So these words aren't alien to them, and they are cognizant of the need for all of that against a backdrop of safety and soundness.
I think the UK government's encouraging the regulator to foster innovation at the moment, and that brings with it its own challenges, I imagine.
Yes, and also competitiveness. So it's innovation and competitiveness, and making sure that the UK has a vibrant capital market going forward.
Do you think it can have a vibrant capital market going forward?
I think the UK has still got, one of the most significant vibrant capital markets in the world. And I think that the UK authorities have done a reasonable amount to foster that. If you put aside for a moment the willful self-harm of leaving the European Union, which is the effects of which I think are still being felt, there is still every reason to think that this is like an important place for banks and an important place for expertise in this sector. But of course, there have been a number of people over the last couple of years sounding some alarm about the movement of, for instance, listings out of the UK to what are perceived as deeper pools of capital. So, and that's one of the arguments, incidentally, in the idea of introducing a little more appetite for risk into the economy, because people want to make it friendly for investors to think, hey, we've got some commercial freedom here and we can make some money within the rules. And so that's part of this debate about where do you set the balance on regulation.
I didn't mean to drive us into politics and
No,
Brexit, but I did want to ask the sort of probing question. Do you think that the UK regulators feel that pressure that we have to up our game?
Definitely. Do you mean in terms of innovation and competitiveness?
As post Brexit,
yes,
and trying to, as Stephen says, foster an environment, a really strong environment for financial services here.
I think they're trying hard to get the balance right. So there are certain regulations, MiFID, MAR, MiFID II, MAR, where the UK regulators were instrumental in putting them into play. And so as they get repealed and reintroduced into the UK landscape, you'll see they don't change very much. But there are, because fundamentally they need to protect the environment that we operate in. But in the example of the listing rules, there was a lot of noise around premier companies going to other markets, and the regulators responded to that, and they've drastically simplified the framework. I was there when we had the premium market, and that doesn't exist anymore. But then in those days, we didn't have the prospectus directive, and that being now well established and settled, having that level playing field with the rest of global markets does make sense.
How do you think the UK regulators are doing?
Okay, I think overall the UK regulators are rightly still well regarded globally. It's been kind of interesting to me, having spent a long time on the, as it were, the user side of regulation as a compliance officer and a risk officer, to see in recent times how critical of the UK regulators some of our democratic institutions have been. So we've seen reports from the House of Lords and the Common Select Committee and so on, which have been actually critical of the FCA in ways that I've not recognised. So it's kind of interesting, I mean, I suppose it shows that our public institutions are working and the public debate is still, still functioning around these things. One of the things that I think the regulators in the UK have done very well, and it links to a point that Sally mentioned earlier, was moving on to look outside of the obvious things and think about where some future points of failure might be. For me, the move out of the classic numerical financial risk, credit risk, market risk, insurance risk, liquidity risk, and move into what we think of as non-financial risk, so whether that's operational risk, financial crime, fraud, platform failure, classic failure in people, processes, systems, those kinds of things. I think the UK regulators have got quite a good record over recent years in pushing firms to think about odd things that can happen. And Sally mentioned this point about the not looking for the impossible, but the really unlikely, because you kind of know that if something's really unlikely, it will quite often bring with it a disproportionate impact in the unlikely event it happens. So I think the push into operational resiliency and the push into operational risk more generally. And I also think at the European level, which I think you're seeing mirrored to some extent in the UK, and you'll see more of it. If you think about the Digital Operational Resiliency Act, all of that is about looking for stuff that's out there in an industry that's changing shape, where we might not yet know where the problems are, but can we look for them? And I think they've been quite good at that.
That's a great segue into DORA, but I actually just wanted to ask Sally the same question because you've seen it from both sides of the fence. So same question to you, how are the regulators doing?
I think banks would say, I mean, obviously they don't like to come into contact with the regulators, but they see it as the medicine they don't like, but they know they need to have. And in terms of, do they think the UK regulators are a credible force and generally speaking understand the complexities of working in a banking institution? I think they appreciate that, particularly when they come into contact with other regulators. And the approach that the UK regulators take in the sense of proportionality, even though they're way more intrusive than they were pre-financial crisis, doesn't get to the same levels of analysis and data requests that some of their European or other regulators might take. So I think all in all, the banks would say, which I agree with, that they've got a good balance of, with our UK regulators, of proportionality, insight, but firmness in terms of the things they care about. What you'll always find is that they point to risk management, governance and culture always as root cause regulatory failings. So in one sense, the ex post analysis on any issue will tend to, at an overarching level, point to those failures. And the key for the regulators is to really prioritise where they're going to put their energies. So there are some things that the regulators do where you might say, why are they, and the press actually pick it up all the time, why are they going down that route? Why are they picking up that issue? And I do think that they should continually do what they tell banks to do, which is to stand back, look at their objectives, their statutory objectives, and look at how they're delivering those, and really focus in on the areas that are going to cause harm to the either financial stability or to market integrity.
In the UK, it's my experience talking to some of our customers that they're not fully aware of their obligations under DORA. Do you think that there is a risk that there are multiple firms out there who don't?
I think it is a risk. I guess over recent years we've got used to the idea that, DORA being an EU legislative act will apply in the EU, and that we've taken a different path since Brexit. But the fact of the matter is that the concentration of financial institutions in the UK that still do business in the EU and vice versa, and the presence of platforms in both the UK and the EU that are used by firms in the other jurisdiction means that you don't have in any of the conventional senses to be an EU firm to be caught by DORA. So the way that DORA, the Digital Operational Resiliency Act, is meant to operate is it's meant to operate in respect of financial firms of all sorts of descriptions in Europe, and financial firms and their supporting platforms that do business into Europe. So to be a financial entity under DORA, it's all the usual suspects, everything from asset management firms, banks, e-money platforms, all of those things, and a lot of others besides, like not obvious regulated institutions, and what are called information and communication technology service providers who underpin them. And so the net of DORA is very wide, both jurisdictionally. You can be sitting in London and providing essentially a service into the EU. You will find yourself being caught. You may be in the UK, you will have a subsidiary in the EU that provides services to you. It will be caught, and so on. And it's also wide because you may be thinking, well, I'm not a regulated financial institution. I actually provide a settlement platform, or I provide a currency platform, or such a service to regulated banks and brokers. You're probably caught by DORA. So it's a very wide-ranging piece of legislation, and what it's really about is saying, you know, some economists like John Kay have remarked in recent years, modern companies don't exist in the way they used to. They, you know, all the companies you can think of, all their business is really done on other people's platforms, whether it's manufacturing or service provision. And so the EU has attempted to say, well, if we look at how all these really important businesses, which are important to financial stability, operate, there's no there. You go to a bank and their operation is actually in a broker they've hired, or it's on a platform, or it's in a service centre, or it's in a digital format in another country. How do they know that won't fall over? You can't go to the bank and say, these are the things that operate the bank, and we know they're all there and they're good, because they're being done elsewhere. And all the stuff around DORA is aimed at that. So I think people haven't registered that yet, to your original question, just how easy it is to get caught, how many tentacles and how long those tentacles are. And I think the fact that it came out of the EU means that people, particularly in the UK, haven't really registered it, and people aren't really ready for it.
There's a detachment there, isn't there?
Yeah,
Jane? And even though it's pretty much being parallel tracked, isn't it? The UK with EU legislation, still at the moment people think, oh, that's EU legislation, doesn't apply to us anymore.
Yeah.
And do you think they've, because one of the things that I reflect upon is the extent to which they recognise that this then impacts their relationship with their suppliers, and really asking the right questions of their suppliers, and not just accepting the answers, almost like that due diligence that needs to be carried out in respect of that.
Sorry, Sally. I think this is really at the core of it, because if I was going to write the title of DORA, I would actually have called it the Third Party Risk Management Act.
Exactly.
Because, you know, we in the industry for years, we've been both as regulators and compliance officers, we've been talking about, well, what do you have to do in the supply chain? How do you know, like, down the supply chain? And that's gone from everything from, like, ESG through to anti-money laundering, checking what people are doing down the supply chain. And this is like an almighty sledgehammer to force third-party risk management into all systemic and non-systemic institutions across our industry and across the economy in a way which will require people to do, for instance, I mean, I won't attempt to summarise all of the Act, but I mean, it requires detailed due diligence when you contract with a platform provider or a service provider or whatever, detailed due diligence. It requires you to make clear in your contract what the responsibilities are and how you're going to obtain assurance on the quality and continuity of the service. Who's responsible for incidents, outages, risk impacts, how are they going to get reported to the authorities, what's your plan for remediation, all of those things. And when you think of the complexity of the sort of digital platforms that are referred in this, that's a lot of stuff. That's a lot of real stuff to be done if things might go wrong.
And the way that I sort of think about it from a practical perspective is, so what's going wrong? Lack of documentation. So the due diligence is done, but then it's not properly documented. Vague or incomplete answers that come through suppliers that then you don't go that extra mile in the challenge. Delayed incident reporting. So when things do go wrong and the supplier doesn't tell you, and tries to, it's that whole regulatory problem. Tell us that's gone wrong and then tell us when you fixed it. Infrequent testing. So when making sure that everything is kind of operating as it should be, and then just the systems and controls around third-party management within a firm will in many cases need upskilling.
It seems to me that the uncertainty is not so much about whether or not DORA applies to the firm, it's actually about the scope.
Yeah.
And actually, to your point, Sally, this is the vendor's problem in my mind, not the bank's problem. Actually, the vendors should be pre-packaging the answers to all of these questions.
I think that there is a responsibility on the vendor, absolutely, but the banks won't ever be able to discharge that responsibility.
Sally, how can compliance teams keep up with technological advances?
There are quite a few things I think they can do, and we've talked about some of this. The first is moving from tactical technology to strategic technology, and using it as a replacement for some of the manual processes, so to take monitoring and surveillance to the next level. So being willing to invest the time to understand, push for the investment, and be innovative, be more proactive than reactive, which is in some ways goes a bit against the compliance officer's mindset. But, to really think about the investment in technology, continuous training. I mean, it's evolving all the time, and using the right tools to train both the compliance team itself, but also the users of the technology, I think is really important. Collaboration. So this is compliance officers can do this more easily without getting into antitrust issues. I think it's being able to compare and contrast across the market with peers. So using that network to actually engage, and then moving into proactive monitoring, as a result, which will have huge benefits, I think, for compliance teams.
Yeah, I'd agree with that very much. I think, to expand on one of your points, I think there's a great opportunity for compliance officers to become proactive and to become advocates for change. And I think there's even a self-interest piece for the compliance community in becoming advocates for change, because if you think about a future state in which we're all more reliant on technology, most people don't want to be in a place where technology is done to them. They want to be an active agent in how technological change happens. I think smart people want to be an active agent. And of course, in the sort of compliance world, I think that involves compliance officers thinking about future state and thinking about the attraction for the business people who are paying the bills for compliance of that future state. Now, as the front office and the business people move further into advanced technology applications in their business, I find in conversations I've been involved in recently that they are far more open then to a conversation from support or second line services that say, that clever stuff that you use for product design, well, we've got something which could do a similar thing with compliance, which is like much cheaper, much more efficient, much more accurate. I can answer your questions much more easily. It requires you to fund it, but it's much smarter compliance. And I've been in a couple of conversations recently with clients where the front office people completely get that joke, and it does require compliance people to be active and be advocates for change, which I think, to Sally's point, may not be where we started, as a profession.
Do you think that there's a responsibility problem in terms of innovating without and still meet your regulatory compliance obligations? Is it possible to innovate while you're still trying to meet the obligations that you have?
I might draw out 2 points on that. One is keep the regulators apprised of what you're doing. And bring them with you on the journey, because they're reliant on that, number one, to see how market practice is evolving, but also and they're quite reluctant to tell you whether you're doing something right or wrong. But in the case of innovation for managing risk through technology, I think they are welcoming of firms, because that's what they're trying to do themselves. So I would say keep the regulators up to date. And the other one I would always have in front and centre is ethical considerations. So when you think about technology and technology risk, think about it in the context of ethics and culture, as well as kind of, does this technology deliver on this specific quantitative risk management process that we're trying to think about? Because that's the easy bit in some ways. It's that broader ethical piece.
Yes, I agree. And I think this is another area where compliance officers need to be advocates. I don't think you can expect the regulator to come to you and say, oh, well, let us hold your hand while you change the process. I think it's up to compliance officers to, after they have got the business to buy into the idea and agree on a forward agenda, and indeed fund a forward agenda, to then be an advocate with the regulator and say, look, you know where we are at the moment and we want to get over here. The business are on board. It's going to be a disruptive process and you will see some dips in the road, but come with us on the journey, and then at the end of it, our surveillance will look like this or our oversight will look like that. And in general, supervisors are pretty good if you take the time to talk them through what you plan to do, and you know, to one of Sally's earlier points, tell them along the way, and we just got here and we're not there yet, and then we're doing this. Generally, they're pretty good.
Yeah, they want to see the constant evolution and improvement, I suppose.
Yeah.
That's the main thing, isn't it?
Yeah.
Sally, Stephen, thank you.
Pleasure.
If you've made it this far, thank you. You got it to the end, and this is my opportunity to ask you to like and subscribe. It really helps with the algorithms on the platforms as we look to grow this channel. We've got some really interesting interviewees coming up, and you'll get notified of those as they happen. Thank you.